Hi there, welcome to our webinar today. The main topic that we've got today is trusts and tax planning. My name is Jamal Khan. I'm a senior tax partner at Churchill Tax. I've got our tax director Hazel Johnston here. Today's topic is very important as people consider tax planning for their loved ones and how to best protect their estate. So the use of trusts is a common question that's asked. There are pros and falls with trusts, which my colleague Hazel will discuss today. Without further ado, can I ask Hazel to make a start and share her slides? And if we have any questions and answers towards the end of this webinar, I'll be more than happy to answer, or Hazel will be more than happy to answer, in fact.
Okay. So you should see my slides. So what I'm going to talk about today is tax planning and trusts. It'll be a bit of a canter through the tax treatment of trusts, and in some ways sounding a note of caution about using them for tax planning, but also, you know, suggesting that there are still things that you can do for them. They're not as attractive as they once were, but they still have their uses. So Churchill Tax Advisors are a specialist tax advisory firm based in London and Essex with national coverage, and we specialise in all types of tax planning, including income, business and inheritance tax planning, tax investigations, UK and offshore trusts, and VAT and stamp duty planning, as well as research and development tax credits. So I'm going to talk about trusts and their tax treatment, mainly concentrating on inheritance tax and a little bit about income tax and capital gains, and then talk about a couple of opportunities that trusts still offer you. So it used to be, before 2006, when Gordon Brown sort of revised the tax treatment of trusts, that life used to be split into life interest or discretionary trusts. And a life interest was broadly treated as a look-through. So if you were the life tenant, so that meant that you were entitled to get the income of the trust for your life, then the underlying trust assets were treated as being in your estate. So that would mean they were tax-free to set up for inheritance tax purposes. But when you died, you would be taxed as if the assets were still in your estate. And that surprisingly actually allowed you to do some tax planning. And so the regime was changed so that now life interest trusts are treated the same as discretionary trusts. And they have a regime where you pay inheritance tax on assets entering the trust. There's 10-year anniversary charges, and then there are also exit charges. So to give you a bit more detail on that, so you have a nil rate ban of £325,000, which you don't pay inheritance tax on death. But it's also available for gifts that you make during life. So if you create a trust, you pay a 20% inheritance tax charge on the value of your addition to the trust, but you can set the nil rate band against that. And on every 10-year anniversary of the creation of the trust, there is an anniversary charge, and the calculation of this is actually quite complicated, but broadly, you look at how much the value of the trust exceeds the nil rate band, and then you charge 6% on the value of the assets at that point. And if property exits the trust, if you make a capital distribution, so if the trust owns a house and then you distribute the house out of the trust, then what they say is, well, you would have paid an exit charge in, however many years' time, so you'll have to pay a proportion of that exit charge, of that 10-year charge when you do an exit. So if it leaves after 5 years from the last 10-year charge, you'd pay 3%. But the thing to watch out for is you can end up in the worst of both worlds. So if you have a trust where you are both the settlor, so you've created the trust, but you are a beneficiary as well, and it doesn't have to be a right to get income. It can just be that the faint chance that you're going to be considered as somebody who's going to get the capital of the trust back, then you'll be in what we call the gifts with reservation of benefit rules. And what happens then is it's treated as if it's still in your estate for inheritance tax purposes on your death, but you're also, the trustees are having to pay these 10-year charges. You will have paid your 20% upfront tax charge on the creation, and the trustees will have to pay exit charges on leaving the trust. So you really don't want to be setting up lifetime discretionary trusts where you are still the beneficiary and where the value of the property is over £325,000 or £650,000 if two of you are setting it up. And they're not very good from an income tax or a capital gains tax point of view either. So the trustees pay income tax on any income that arises to the trust at the highest rate. So they don't get a 20% rate at all. But when they make distributions to lower rate taxpayers, those taxpayers can reclaim the tax. Now, obviously, this is a bit of a faff and a nuisance because you pay the tax, you then give it to the revenue. The revenue, you have to prepare tax returns, you have to do forms to indicate to the beneficiaries what tax has been paid. You give those to the beneficiaries file their tax returns, they reclaim the tax, and it becomes quite a burden from an administration point of view. But what you can do is get around that by sort of mandating the income. So you basically say, we will be giving the income of this trust to these beneficiaries in this proportion from now on. And when you've done that, then you can treat the income as arising to the beneficiary directly, and you don't have to go through this administrative burden of reclaiming tax. On the side of CGT, trustees are paying the highest rate of CGT that applies, and there's no reclaim mechanism. So they pay that tax, and they will not be able to, the beneficiaries, if a distribution is made to them, will not be able to reclaim that tax. So why, bearing in mind these downsides, would you use a trust? Well, I mean, one use is where the grandparents can set up a trust for the grandchildren. So if you've got two nil rate bands, you can settle a trust for up to £650,000. There'll be no inheritance tax on the creation of the trust, and you will get at least the first 10 years of that trust as being free of IHT. And then distributions can be made either just before or just after the 10-year anniversary to the grandchildren, and there wouldn't be inheritance tax on that because the way the exit charge is calculated looks back to that first point of creation, when no inheritance tax was due. If you're prepared to go through the process of making distributions of income to the grandchildren and then reclaiming the tax, you can use their personal allowances and basic rate tax bands tax efficiently to shelter income, and it allows for control and protection of family assets. Now, if you've got a large estate, then this is only going to be marginal compared to other sorts of planning that we can advise on, but it's still something that's worthwhile thinking about. I mean, for some people, it can be used to pay for school fees if that's an issue, or it can be used to sort of put together a deposit for a first home. It can be used to set somebody up in business. It's just something that allows you to save a little bit of tax that can be useful for setting up your grandchildren when they turn 18. There are other uses of trust. So there are uses of trust on death and in wills. So we have what we call an immediate post-death interest will, an IPD for short. And an IPD is a trust that's created on the death of somebody and created not necessarily in a will, but generally it is in a will. And you leave all your assets to a spouse. And then on their death, so they only get a life interest, so they're allowed to sort of have the use of the house whilst they're still living. They can have income from the trust assets, but they can't use the capital unless the trustees decide to give them some additional capital. And then the bulk of the trust assets are then passed on to the next generation, the children. And that's useful in a sort of a practical family sense, not necessarily quite so much in a tax sense, because it allows you to direct who's going to get assets after your spouse has died. And that's particularly useful for second marriages if you want to keep estates separately, or where you want to sort of direct or make sure that your spouse isn't going to get remarried and fritter away the estate on her new toy boy, or vice versa. So it's a way of protecting the children's assets and their entitlements. And it's also a useful way of sort of having that discussion with your family at an early stage about how you want the family's assets to be disposed of after the second death. There are also other trusts. There's bereaved minors trusts, which again are used in wills, but as it says very much on the tin, it's for minor children. So these are the kinds of things that you put in place where you're still a young couple and the only sort of inheritance tax planning you're worried about is basically both of you being run over by a bus at the same time. And it's put in for the benefit of your minor children, to look after them and to make sure that they're not expected to look after all of the family money on your unfortunate death. And it's a special discretionary trust which ends at 18. And so unlike the discretionary trust we were talking about earlier, when the children reach 18 and they become entitled to the assets of the trust, there's no inheritance tax on winding that trust up. So you don't have to pay the exit charge and you don't have to pay 10-year anniversary charges. So that can be quite a tax efficient way of dealing with if you've got 3-year-olds and 4-year-olds, that can be quite a tax efficient way of dealing with assets in the will in a way that's not really going to lead to inheritance tax charges for your children. There are also more specialised planning uses of trusts. So you could use them to transfer rental properties between family members without paying capital gains tax. You can use trusts when you have business property relief and a trading company. So if you've got a situation where you have a trading company that's going to be handed down to the next generation, you have 2 or 3 children, one of them may want to be working in the company, one of them may not, but they all want to benefit from that company as assets and dividends, but in a way that allows somebody else perhaps to have control or to look after the assets to make sure the family don't fall out. Then because business property relief applies to prevent inheritance tax from applying on the creation and the continuing existence of that trust, it does give people the opportunity to use trusts for the purpose they're actually intended to do, which is to allow a family to divide assets between it, but in a way where central control is concentrated on one trusted family member who's supposed to be looking after the others. There are also trusts for the benefit of disabled beneficiaries, which have beneficial status, and they can benefit from advantageous tax rates as well. In the case of vulnerable beneficiaries, so that's very useful if you've got someone who's got, say, a physical disability and you want to look after them, both during their life and after their death. But in the case of people who have got mental health problems, you can have difficulties where if they sort of occasionally, if they sort of get better and then they get worse and then they get better, so they have a sort of an intermittent condition, in those circumstances, vulnerable beneficiary trusts can have quite adverse tax effects, because you go in and out of the regime and there are tax charges associated with that. So in those cases, it might be better off to do just a straightforward trust and not relying on the vulnerable beneficiary rules. But they're still, you know, a useful tool if you're dealing with somebody who needs effectively looking after for the rest of their life. So in summary, I would say that trusts are not as beneficial as they once were, but they do still offer some tax benefits. If you can get trust assets into a discretionary trust regime tax-free, because you put something in that's an appreciating asset and you don't pay inheritance tax charges on the creation of the trust and you're only paying 6% every 10 years, that can be more beneficial than having tax charges every time somebody in the line of succession dies. It's supposed to work out as about the same tax charge as somebody, because they sort of say people die, a generation lasts sort of 30 years. So 6% every 10 years is the same as 40% every 30 years. But that's not always the case where you're dealing with a steeply appreciating asset. So trust can still form part of the toolkit for dealing with succession, and particularly for protecting families, because even if there is a tax cost associated with setting up a trust, sometimes your family needs mean that it's the appropriate way of dealing with a situation, because the alternative is leaving sort of a vulnerable beneficiary to face making difficult decisions that they're not really fit to make. Or you can sort of end up giving lots of funds to family members who really aren't equipped to deal with that level of money because they're too young or they're too immature, even if they're sort of over 35. So they can still offer both tax planning and family planning, family structuring opportunities. And there's just Jamal and I's sort of contact details and just a note of our experience. And I will stop sharing my screen now and we'll see if we have any questions.
Thank you, Hazel. That's very useful. And I hope our audience, we've got quite a few audience today. This is a very, very hot topic. And some questions I have is, what is the future of trusts, Hazel?
I think the future of trusts is probably quite static, in the sense that all the attacks have been made on trusts that will be made. I don't sense any appetite for any reform of the taxation of trusts at the moment. I think the government has got other fish to fry. There may be some tweaks to the inheritance tax regime more generally, but I think that would sort of maybe deal with business property relief in general, or agricultural property relief, or even, you know, potential exempt transfers and root and branch reform of inheritance tax completely. But I don't see that trusts will be treated any more harshly than they are currently.
And do you think the government is expected to change its stance on offshore trusts? We've done a lot to get to can trusts. Do you think there's more coming?
No, I really don't. I think that people have sort of, the government has reached, or the Treasury more accurately, has reached the end of the road on that. There are suggestions that there are going to be some changes to inheritance tax treatment of things, but I think there are just bigger and easier targets for the government to go after. So I think post-COVID, there's going to be trying to increase the tax base on income tax and capital gains tax, and not so much attention paid to inheritance tax, because frankly, it's not a tax that generates a lot of income, or it's not, you know, a lot of income for the government. So it's not going to be their priority.
Okay, well, that's fine. I'm sure there'll be more questions, and the audience can always email the questions to me or Hazel, or you can call me or Hazel, and we'll be more than happy to help you. We have got a number of clients who have trusts in the UK and trusts offshore, and we often advise them on how to best structure or restructure, or sometimes we have to close a trust, sometimes we have to get assets out of a trust. So it's very, very important that you speak to a specialist, and because otherwise you can get yourself into trouble. I mean, we've seen cases where somebody's just gone and set up a trust and transferred properties into a trust without knowing the full implications. So that's where we can come in, and we can potentially help you, hold your hand, and walk you through how, or help you avoid any pitfalls. Great, excellent. Well, thank you everyone for attending our session today, and we'll see you next month. Thanks a lot. Bye. Thank you, Hazel.
Bye-bye.